Welcome to XRP Pro Ledger, and what I am about to walk you through in this video is the kind of convergence that most financial analysts will not connect for you, because doing so requires pulling threads from geopolitical intelligence, central bank policy, blockchain security architecture, and global institutional positioning simultaneously. And today, every single one of those threads is pulling in the same direction at the same time. There is a $50 billion oil supply shock currently rippling through the global financial system following the Iran conflict escalation. And the resulting liquidity crunch is breaking the SWIFT correspondent banking system in ways that are forcing institutions to find alternative settlement infrastructure in real time. The World Economic Forum's 2030 Digital ID Agenda is accelerating its implementation timeline in direct response to the geopolitical instability, pushing programmable financial infrastructure to the front of the global policy conversation. The United States government is quietly positioning XRP-based infrastructure as a component of its strategic financial response. And right in the middle of all of this, right at the exact moment that trillions of dollars are preparing to move onto new digital rails, Ripple's chief technology officer, David Schwartz, stepped forward today to issue an urgent public warning about DeFi bridge security vulnerabilities, citing the $292 million KelpDAO hack as a critical lesson for every institution preparing to deploy capital on blockchain infrastructure. XRP is holding at $1.42 to $1.43, with $3 billion in daily volume through all of this chaos. And that price stability is not luck. It is proof of utility demand operating at institutional scale. Let us start with the macroeconomic context, because you cannot understand why David Schwartz's warning today carries the weight that it does without first understanding the scale of the financial transition that is currently underway at the global level. The Iran conflict has triggered what analysts are calling a reverse carry trade, a massive forced unwinding of leveraged positions across global financial markets that is generating a liquidity crunch of historic proportions. When institutional investors and sovereign wealth funds are simultaneously forced to liquidate positions to cover margin calls and rebalance portfolios in response to an oil supply shock of $50 billion in scale, the SWIFT correspondent banking system, which was designed for orderly sequential settlement over 24 to 72-hour periods, cannot process the volume and velocity of settlement demand being generated. SWIFT was built for a world where institutional settlement happened in predictable patterns during normal market hours. A $50 billion oil supply shock triggered by geopolitical conflict generates settlement demand that is anything but predictable. And the gaps in SWIFT's processing capability during these stress events are becoming impossible for institutions to ignore. The SWIFT system's structural vulnerability to exactly this kind of geopolitical liquidity shock is not a new discovery. It has been documented by central bank researchers and financial stability analysts for years. What is new is the scale and visibility of the current disruption, which is forcing the institutions that have been privately evaluating alternative settlement infrastructure to accelerate their public commitments to deploying it. SBI Remit's use of XRP infrastructure to settle billions in cross-border value during this period of swift stress is the most visible example of that acceleration in action. But it represents a pattern that is playing out across dozens of institutional relationships that have not yet made public announcements. The institutions that were quietly running XRP settlement pilots during normal market conditions are now running those same systems at full operational capacity because the geopolitical stress event has made the alternative, continued reliance on SWIFT during a liquidity crunch, too costly and too slow to be viable. Crisis accelerates adoption in institutional finance, and the current oil supply shock is the crisis that is accelerating XRP's institutional adoption from pilot scale to operational scale in real time. Now let us talk about the WEF's 2030 agenda, because investigative reporting from journalists like Whitney Webb has documented the architecture of what is being planned at the global policy level in ways that are directly relevant to understanding why XRP's infrastructure is being positioned the way it is. The World Economic Forum's vision for 2030 includes the implementation of digital ID systems that would serve as universal identifiers for individuals participating in the financial system, the same unified ledger architecture that Larry Fink has been describing from Davos stages, where every asset and every participant carries a unique digital identifier. The programmable financial infrastructure that digital ID enables is genuinely dual-use technology. It can create more efficient and accessible financial systems, and it can also create surveillance and control mechanisms that represent a significant threat to financial privacy and individual autonomy. Webb and other investigative journalists are correct to document and scrutinize this architecture because the policies being designed at the WEF level will shape the financial infrastructure that billions of people use, whether those people are aware of the design process or not. The critical distinction that needs to be made clearly in this context, and it is a distinction that the most sophisticated XRP holders understand, but that gets lost in the noise of the debate, is between the infrastructure layer and the policy layer of digital financial systems. The XRP ledger is infrastructure. It is a neutral settlement layer that can be used by institutions operating within centralized regulatory frameworks and by individuals seeking decentralized financial alternatives, depending on how it is accessed and deployed. Ripple, building institutional relationships with banks and governments, does not predetermine how the underlying XRP ledger will be used by the billions of people who will eventually access it. The ledger's decentralized architecture means that no single entity controls who can participate in it or on what terms. The distinction between owning XRP as a decentralized asset and participating in any specific institutional deployment of XRP infrastructure is the same distinction as the difference between owning gold and using a specific bank's gold custody service. The asset and the institutional wrapper around it are separate things, and understanding that separation is essential for navigating this moment clearly. Now, let us get to the development that David Schwartz stepped forward publicly to address today, because his decision to issue an urgent warning about DeFi bridge security vulnerabilities at this specific moment tells you everything about the stakes involved in the current transition. The $292 million KelpDAO hack is the specific exploit that Schwartz cited as the catalyst for his warning. And understanding what happened technically in that hack is essential for understanding why his warning is directly relevant to the RLUSD rollout and the broader institutional deployment on XRPL. KelpDAO was a DeFi protocol that relied on cross-chain bridge infrastructure to move assets between different blockchain networks. And the exploit that drained $292 million from it targeted the bridge layer specifically, the mechanism through which assets are locked on one chain and representative tokens are minted on another. Bridge exploits have been responsible for the majority of the largest DeFi hacks in history, including the $625 million Ronin bridge hack and the $320 million wormhole exploit, because the bridge architecture creates a specific type of vulnerability that does not exist in native single-chain transactions. David Schwartz issuing this warning specifically in the context of RLUSD's massive rollout is significant because it signals that Ripple's technical leadership is actively monitoring the security architecture of every channel through which RLUSD and XRP will be deployed, and is willing to publicly flag concerns even when those concerns involve partners and products in Ripple's own ecosystem. That is a level of technical candor that is unusual in the blockchain space, where projects typically downplay security concerns to avoid creating negative sentiment around their products. Schwartz's decision to make this warning public, rather than addressing it privately through internal channels, tells you that he believes the scale of what is about to move onto XRPL infrastructure is large enough that the security considerations must be part of the public conversation. Because if a bridge vulnerability is exploited at the scale of an RLUSD deployment, that is serving institutional clients, moving billions in regulated stablecoin value. The damage is not just financial. It is reputational and regulatory in ways that could set the entire institutional DeFi adoption timeline back by years. The RLUSD stablecoin's rollout represents the most significant product deployment in Ripple's history as a company. And the scale of what Schwartz is trying to protect with his warning cannot be overstated. RLUSD is Ripple's dollar peg stablecoin, designed to operate natively on the XRP ledger and serve as the dollar-denominated liquidity layer for institutional cross-border settlement. When institutions use XRP for cross-border payments, they often need a dollar-denominated asset to represent the value being transferred at specific points in the transaction. RLUSD fills that role while remaining on the XRPL, eliminating the need to exit the XRP ecosystem into traditional banking rails for the dollar leg of international transfers. The potential deployment scale for RLUSD is not measured in millions. It is measured in the trillions of dollars in annual cross-border settlement volume that currently flows through SWIFT and correspondent banking networks. And even a single-digit percentage capture of that volume would represent a deployment scale that dwarfs anything the DeFi space has ever managed. Protecting that infrastructure from bridge vulnerabilities is not a technical nicety. It is a prerequisite for the transition to function at institutional scale. Let us examine the specific security architecture concerns that Schwartz is raising. Because understanding the technical distinction between bridge-based DeFi and XRPL's native protocol design is essential for understanding why the XRP ledger is positioned as the most institutionally viable DeFi infrastructure, despite the security challenges facing the broader space. The fundamental problem with DeFi bridges is that they require a trusted intermediary, whether that intermediary is a multi-sig committee, a set of validators, or a smart contract, to hold locked assets on the source chain while issuing representative tokens on the destination chain. This architecture creates a honeypot, a single point of concentrated value that is connected to the open internet and is accessible to any attacker who can compromise the bridge's security mechanism. The larger the bridge's total value locked, the more attractive it becomes as an attack target, creating a perverse incentive where the most successful bridges are also the most dangerous. XLS65 and XLS66, the native lending protocols being voted on by XRPL validators, are being designed specifically to avoid this architecture by building yield-generating functionality directly into the XRP ledger's base protocol layer, where it is governed by the same consensus mechanism that has secured the ledger without a significant exploit for over a decade. The timing of Schwartz's warning relative to the KelpDAO hack and the RLUSD rollout reveals a sophisticated institutional risk management calculus that deserves to be understood for what it is. Schwartz is not warning about a hypothetical future risk. He is responding to a demonstrated, recent, large-scale exploit that used exactly the kind of bridge architecture that would be involved in any cross-chain deployment of RLUSD at scale. The $292 million KelpDAO hack is the data point that proves the risk model, and Schwartz is using it publicly to signal to every institution that is evaluating RLUSD deployment that Ripple's technical leadership is aware of the risk and is actively prioritizing security architecture over deployment speed. In the institutional finance world, that signal is enormously valuable. Institutions that are evaluating whether to deploy significant capital on RLUSD infrastructure need to know that the technical team governing that infrastructure is not making speed versus security trade-offs that prioritize growth metrics over client capital protection. Schwartz's public warning is Ripple's technical leadership demonstrating in the most visible way possible that they are on the right side of that trade-off. The geopolitical backdrop of the Iran oil supply shock interacts with the institutional XRP deployment story in a way that creates an urgency compression. The combination of financial system stress and institutional infrastructure readiness is forcing adoption decisions that would otherwise take months or years to make. When the SWIFT system is under stress from a $50 billion oil supply shock, institutions that have been quietly running XRP settlement pilots at small scale suddenly have a business case for scaling those pilots to operational capacity that did not exist during normal market conditions. The settlement speed advantage of XRP, transactions confirmed in 3 to 5 seconds compared to Swift's 24 to 72-hour timeline, goes from a nice-to-have efficiency improvement to a mission-critical operational necessity when a liquidity crunch is generating settlement demands that Swift cannot process fast enough. Crisis creates the urgency that transforms pilot programs into full operational deployments. And the current oil supply shock is exactly the kind of crisis that is generating that urgency across the institutional landscape simultaneously. The US government's quiet positioning in XRP infrastructure during this period of geopolitical and financial stress is the piece of the story that most analysts are either unaware of or unwilling to discuss explicitly. But it is the piece that explains the strategic reserve inclusion, the bank charter approval, the Fed access application, and the legislative acceleration of the Clarity Act as a coherent and coordinated set of policy decisions rather than a series of independent coincidences. When the US government includes XRP in a strategic crypto reserve, approves Ripple's application for a national trust bank charter, and accelerates the Clarity Act's legislative timeline simultaneously, the coherent interpretation of those three actions is that XRP infrastructure is being positioned as a component of the United States' strategic financial response to a global financial system that is under stress from geopolitical instability. The SWIFT system's vulnerability to exactly this kind of geopolitical shock has been documented in U.S. Treasury and Federal Reserve research for years. And the policy response to that documented vulnerability is the infrastructure deployment that we are watching unfold in real time. David Schwartz's warning about DeFi bridge security fits into this strategic picture in a way that elevates it from a technical caution to a national financial security concern. If the United States government is strategically positioning XRP infrastructure as a component of its response to SWIFT system stress, then the security of that infrastructure is not just Ripple's commercial concern. It is a national security concern in the most direct and literal sense of that phrase. A successful large-scale exploit of RLUSD's bridge infrastructure during a period when U.S. strategic financial positioning depends on the reliability of that infrastructure would be a geopolitical event, not just a financial loss. Schwartz warning publicly about bridge vulnerabilities in this specific context is a technical leader performing exactly the function that a responsible CTO should perform when the stakes of an infrastructure failure extend beyond his company's balance sheet into the stability of the financial systems that his company's infrastructure is designed to serve. The XRP price stability at $1.42 to $1.43 with $3 billion in daily volume through all of this global market chaos deserves to be examined as the data point it is, rather than simply noted as a price level. When equity markets are volatile, when oil is swinging dramatically in response to geopolitical conflict, when the SWIFT system is under stress, and when the DeFi space is absorbing the impact of a $292 million hack, an asset that holds its price level with $3 billion in daily volume is demonstrating something specific about its demand structure. That volume is not retail speculation maintaining price. Retail speculation collapses during geopolitical uncertainty because retail investors reduce risk exposure when headlines are scary. $3 billion in daily volume during a period of global market chaos is institutional settlement demand. It is the actual use of XRP as a utility asset for cross-border value transfer at institutional scale. And utility demand is the most durable and price-supportive form of demand that any asset can have because it is generated by operational necessity rather than investment sentiment. The complete picture that David Schwartz is warning, the KelpDAO hack context, the RLUSD rollout scale, and the global macroeconomic backdrop together create is one of an infrastructure transition happening at unprecedented speed under conditions of genuine geopolitical stress, and the people responsible for the technical integrity of that infrastructure stepping up in real time to ensure it is bulletproof before the full weight of institutional capital lands on it. Schwartz is not issuing a warning because XRPL is vulnerable. He is issuing a warning because the broader DeFi space has demonstrated vulnerabilities through the KelpDAO hack that must not be allowed to compromise the XRPL's institutional deployment when the stakes are this high. The distinction is critical. He is the CTO of the infrastructure that institutions are choosing precisely because it is safer than the alternatives, and he is publicly reinforcing the security standards that make it the safe choice precisely because the transition is moving fast enough that complacency is the real risk. The oil supply shock is forcing the adoption. The WEF's 2030 agenda is setting the policy framework. The US government is positioning the strategic infrastructure. And Ripple's CTO is making sure the pipes are bulletproof before the flood arrives. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.